The Federal Reserve's financial stability report just came out, and here's what you need to know about it. There's a couple of new pieces of information in it, including some risks, key risks related to the stock market. What's also in the report relates to the ongoing credit and lending deterioration that's happening right now. The economy is supposed to be booming and everything is supposed to be inflationary, yet other new data from the Fed shows declines in consumer lending and more and deeper drops in commercial and industrial lending tied to the risks that are described in the financial stability report. And there is a high degree of correlation for that last one with the unemployment rate. In fact, that correlation is already being established all over once again. And if all of this continues to go on in the same way, those risks that the Fed is talking about with stocks and even the real economy, they're not going to stay risks for very long. Now, the Financial Stability Report comes out twice a year. The last edition was published back in October. The latest one was released just a few days ago. Now, normally this is an exercise to reassure the public that everything is just fine, and this edition is no different. They tell you that the banking system is strong and the financial markets are resilient, but just in case some of these things happen, we want to be able to tell you that we warned you ahead of time there were substantial risks in these various places. The FSR in many ways is an exercise in CYA. And those risks are exactly what you would already expect, just what we've been talking about, starting with commercial real estate. Now, the Federal Reserve does have insight into commercial real estate and banking that we don't have because we can't compel information from the banks in the same way they can. But essentially, they just confirm what we already know. Nobody is doing anything at the moment. What the FSR said was, aggregate CRE prices measured in inflation-adjusted terms continued to decline over the second half of last year, with declines in these price measures broad-based across all CRE sectors. These transaction-based price measures likely do not yet fully reflect the deterioration in CRE market prices because, rather than realizing losses, many owners wait for more favorable conditions to put their properties on the market. So the FSR report shows a continue to decline in prices and then references this thinly traded market, which means we still don't have substantial price discovery in CRE just yet. Everybody is just waiting. And we're waiting to see if the amount of properties that come available for sale for not good reasons, foreclosures and takeovers and that kind of thing, we don't know where the buyers are. We don't know how deep the buyers are. We don't know what price buyers are willing to buy at. So we have still all of this CRE stuff in front of us. And that's what the FSR's message really is about. We don't have a good handle on where commercial real estate risks are going to go. And those risks can be potentially substantial. But because everything has been the can has been kicked down the road this far already, the urgency behind commercial real estate has dropped back a little bit. In fact, of the 25 market contacts that are surveyed by the Federal Reserve Bank in New York, there were slightly less of them worried about commercial real estate or saying that that's their top worry than there were back in October. But it's not like commercial real estate has disappeared from their radar. It went from around 70% down to 60%. So they're a little bit less pessimistic about the CRE space, given the fact that they've been able to kick the can down the road this far already. Well, that doesn't mean that they can continue to kick it down because, as the Fed was pointing out, we still don't know what the prices really are going to be when everything does start to fall out and shake out, as it has to. Because this is still a major imbalance. Banks are still on the hook for a lot of it. And furthermore, we don't know what the potential spillover will be as that price discovery becomes revaluation and therefore may hamstring the banking system even more than it already is. Back to the FSR. In the US, unexpectedly weak economic growth could lead to a reduction in investor risk appetite and additional strains in CRE, especially in the office building sector where vulnerabilities have mounted in the post-pandemic period. A more pronounced correction in commercial property prices could result in significant losses for banks and non-bank investors with concentrated exposures to the sector. Such losses may reduce the willingness of financial intermediaries to supply credit to the economy, which would further weigh on economic activity. Thank you, Captain Obvious. We all know that that's the case. Commercial real estate is highly macro sensitive. So if the economy does deteriorate, that means the CRE situation is going to deteriorate even more than it already has, whether it's gotten to that point of revaluation or not. So further risk to the commercial real estate sector also means further risk to the banking system. And let's face it, despite all the rosy rhetoric, especially about the economy and macroeconomic statistics, the banking system is telling you the opposite. Banks are already scaling back credit, and in a way that is more immediate and more substantial than even the FSR report shows. The slowdown in credit creation and debt in the real economy, especially to businesses, that really didn't pick up until toward the end of last year, really the fourth quarter entering this year. And that's where we're going to turn to the H8 statistics, also from the Federal Reserve, but these are more updated, compiled weekly from bank call reports and everything else. So we have a more timely snapshot of what the banking and credit environment actually looks like right now. In terms of total lending, overall loans, those were growing up until around the banking crisis last year. So February into March, you see an inflection in total lending, and so it was flat to slightly lower all the way through to July. But then bank lending picked up, but just a small amount during last summer, and that lasted until the end of October. And then from October through to the end of the year, consistent with the bond rally, banks started to cut back on their loans all over again. And then when the bond rally ended and rates started to go up again, so did lending. Lending picked up a little bit, just a modest amount, like basically the same as they had done last summer, January through the end of February. But now look at what's happening recently. Total lending is beginning to flatten out all over again. So the correlation with bond yields, as well as the behavior in the banking system, is really about safety and perceptions of risk. So bond yields go down, which is a sign of flight to safety, lower growth and inflation expectations. So you would expect that banks would cut back on their riskier activities, including extending loans. And we look at it by specific categories. Consumer loans, those had started to decline again October through the end of December, which was the bond rally, flight to safety, risk aversion. Then consumer loans picked up a little bit in January and February. Maybe that accounts for some of the increase in marginal retail sales, for example, over those, especially February into March. But then consumer loans at commercial banks shrinking again March and now April. So risk aversion that would have been tied to the bond rally, but there is no bond rally because the Federal Reserve has now focused itself on inflation. But more important than consumer loans, commercial and industrial loans. Commercial and industrial loans are highly cyclical and a very good cyclical indicator. And I talked about this in a video back on February 6th, how there was a really good correlation between the Federal Reserve's Senior Loan Officer Opinion Survey that surveyed loan officers about whether or not they were tightening lending standards, and the relationship with commercial and industrial loans and some other credit statistics too. And then furthermore, what really made this all the more compelling was how C&I loans tied into the unemployment rate. And what we found was that the Senior Loan Officer Opinion Survey, or SLOOS data, was about 18 months ahead of time. So when you see peak tightening in credit standards, that would have its peak impact on commercial and industrial loans about 18 months down the road. And so what that meant was, as senior loan officers tightened their lending standards, as banks tightened their lending standards last year through the middle part of last year, we should therefore expect the heaviest impact, the biggest declines in lending in commercial industrial loans in the second half of this year. Updating the statistics after we went through this in February, you can see that declines in commercial industrial loans have indeed accelerated. So they are still consistent with the pattern, the 18-month lag pattern, with the tightening in credit standards. And as I just mentioned, where that comes in to the real economy is the relationship between C&I loans, a really good relationship between C&I loans and the unemployment rate, or the underemployment rate if you prefer that one. And just to be clear, the unemployment rate and the underemployment rate here we're showing you on an inverted scale. So rising unemployment is going down on the chart. But essentially, there is a very good correlation, including this year so far, as commercial and industrial loans accelerate to the downside, we have seen a material pickup in the unemployment rate. It's not enough that people say, oh my God, this is a recession, bad things are happening, but it is a noticeable increase in the unemployment rate. And as I mentioned in another previous video, it is enough to be consistent from the household survey perspective with a recession. So as far as the credit numbers go, and as far as the financial statistics report suggests, banks are indeed acting upon risks. Some of it is tied to commercial real estate potential problems there because, as the FSR noted, Captain Obvious, if the CRE problem gets worse, the banks are going to shut down their credit, not just in the CRE space, but across the entire economy. And they're already doing that, in part because they're likely concerned about how the CRE stuff is going to turn out, as well as how everything in the macroeconomy might actually turn out. There is no guarantee there either for the soft landing. In fact, banks are acting as if that's not even their base case. As I mentioned, the real takeaway from the H8 statistics is that there's another deterioration in credit in the U.S. economy taking place right now, one that includes extension of consumer credit. The other key part of the financial stability report from the Fed related to the stock market. The stock market, well, the Fed is concerned about the stock market because the Fed and the stock market, there's a little bit of a love affair there. Even though there's no direct relationship between the Fed's QE and money printing and bank reserves and share prices, the Fed does realize that there is a strong psychological component to higher stock prices, higher shares and equity prices. And so they monitor the stock market for what may not be the most obvious reasons. Not about money printing, it's about psychology. And there's a two-way feedback as well. What the Fed's financial stability report says about shares is the ratio of prices to expected 12-month earnings, or the PE ratio, increased since the October report and currently sits in the upper end of its historical distribution since 1989. The difference between the forward PE ratio, and here they mean the earnings yield, or the EP ratio, and the real 10-year treasury yield, a measure of the additional return that investors require for holding stocks relative to risk-free bonds, also called the equity premium, that declined on net since the October report and currently stands well below its historical median. Now, what we're talking about with the equity risk premium is another measure of valuations and how stretched they are related to the risk-free rate, or the real risk-free rate, which is the 10-year U.S. Treasury, price adjusted in some fashion. Now, the data I'm going to show you is different from what the Federal Reserve's report did. I'm going to draw my statistics from, first of all, S&P itself, on the S&P 500, the report that they give you on earnings and forward earnings and things like that, as well as what the index price is for each quarter. Take that all from S&P. And then I'm going to use the comparison to the Cleveland Fed's estimate for the real 10-year Treasury rate so that we can calculate our own equity risk premium. And what you see is exactly what the Fed says. It doesn't matter which data source you use, it's basically the same picture either way. And what we're trying to measure is, by turning the PE ratio upside down into a sort of earnings or interest rate, we're comparing that interest rate, and it's not a real thing, we're comparing that interest rate to the real 10-year to see how much additional return we should expect from stocks over and above the risk-free rate. If we use the forward PE measure, that gives you the forward return potential embedded in the stock market, as much as these statistics can actually give you. And so the current numbers using my data set, again, the S&P providing the earnings as well as prices, and then the Cleveland Fed's estimate for the real 10-year rate, you see the stock market risk premium about 1.81% when you subtract the real 10-year rate as of the first quarter of 2024. That's the lowest since the third quarter of 2009, but it's also the closest comparison here is the 1990s dot-com bubble. Now, to be clear here, the equity risk premium is not predictive. It doesn't tell you that stocks are going to crash tomorrow or they're going to continue to soar. All it really tells you is the same thing as valuations do, or the PE ratio might do on its own, which is essentially that stocks are historically elevated compared to earnings, which may mean something, it may not mean something. Furthermore, as you can see on all of the data, the Fed's data, my chart, and everything else, the equity risk premium can continue to decline, and the forward risk premium continue to decline, and stocks continue to go up and up and up and up. In fact, that's the reason why those metrics decline. They don't necessarily turn around because the risk premium disappears. And in fact, what the bull market case is that essentially we should expect this type of valuation imbalance because prices recover faster than earnings do. So prices go up much sharper in the beginning stage of a bull market, and then eventually earnings catch up. So this type of more current and maybe immediate focused of a metric, that's not going to give you a predictive view of what stock prices are likely to do, or even really maybe not even a consistent view of where things stand right now. However, what the equity risk premium does suggest is that should something happen in the stock market, there is very little to support share prices where they are now. That includes the earnings estimate, the forward earnings estimate, especially if something threatens both of those, like a recession, as well as by being compared to the real 10-year rate, you don't even have favorable valuation characteristics or return characteristics to the risk-free. That's where this equity risk premium sort of has any value, so to speak. That doesn't mean this is 2009 or it is 1999, 2000 at the top of the dot-com bubble. But if share prices were to turn around, they could indeed fall very quickly because there is very little, I hate to use the term here, fundamental, because that doesn't really apply to the stock market, but fundamental, as most stock market participants might understand the term. So the FSR for April of 2024. Commercial real estate, still going to be a problem. We don't know how much of a problem because everyone has been able to kick the can this far down the road. Thank you, Captain Obvious. There's going to be an issue. There's going to be losses. It's going to hit the banking system. We have no idea what that's going to be because nothing is happening right now. We've looked. We're the Fed. We have the power to look. We don't see anything happening, but keep your eyes on this one. And as they note, as common sense dictates, if things get worse in the real economy, as we're seeing in the banking system, then that will put even more pressure on CRE, which will put more pressure on banks, and you get into that vicious cycle. The current credit environment that we talked about, the deterioration in debt and lending, that isn't necessarily about systemic risk, because even at this stage, maybe there's some possibilities with CRE, but mostly it's about macro risk. Banks aren't too sure about the soft landing. Banks aren't too sure about the environment as it is. And so they are cutting back. Some of it is, again, related to possibilities over CRE and imbalances in their portfolios. However, most of it is this uncertainty about how the macroeconomy is really developing. It's not so rosy as they make it out to be. And that's why we see cutbacks in consumer loans and, more importantly, commercial and industrial loans that do tie very closely to the unemployment rate. So as C&I loans go down, the unemployment rate goes up, and that's what's happened so far, and we should expect more of that. And then finally, the FSR points to the stock market, Wall Street, and says, guess what? Share prices have gotten ahead of themselves. And the bull case is that, yeah, that's what always happens early on in the bull market. However, if something were to threaten earnings, if something were to threaten the narrative around the stock market, then you have little case and little support for where share prices are now, as little as we've seen since maybe the dot-com bubble. That's the risk to shares. It's not that the market's going to crash tomorrow. We have no idea if that's the case. But if something does happen, like a recession, which is always bad for stocks, the downside could be more than people are anticipating, given where expectations are today. It is worth taking a second look at the relationship between credit standards, credit, and the unemployment rate. We'll do just that in the video link below. As always, thank you for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.